Welcome back to the Small Business University. This lesson is going to be a little bit different, not many slides. Instead, we're going to get to know the 1120S form. Sometimes I think tax forms hold this mystery with non-preparers, like they're these massively complex documents that you must have 20 years experience to figure out. This video really is meant to dispel that for you and anyone who has no idea what an 1120S is or what it's all about or how to prepare one. You're going to get a very detailed look at every part of it in this lesson. And the idea being, if you're going to offer this, you don't necessarily need to know every detail of how to prepare it, but knowing the form gives you confidence in being able to sell this service to your clients and to small business owners. So we're going to dive into it so that you have no anxiety about what this is and how it affects your client and exactly what parts of it are easy, what is not easy, and how to make your business much better by offering S corporation tax preparation. So let's jump into this thing, and I'm going to show you from A to Z all about the 1120S. So in this slide, I have the major parts of the tax return. And as I'm going to show you in a minute, most tax returns come with many more pages, but none of them matter much except for these. So if you look at an 1120S, it could be 50 or 60 pages, but as you can see on the screen here, I'm saying that 11 of them really matter. And 11 pages that you must get familiar with, and they will cover probably 95% of the returns that you are selling that are under $250,000 worth of income. Whenever you're talking about under $250,000 worth of revenue, these are very simple 1120S's most of the time. So these pages are going to be the bulk of any return, besides the little support pages and address pages and all the gobbledygook that comes with it. Let me briefly explain each of these, and then we're going to kind of dive into the forms in detail. First, there's the 1120S. This is the actual tax return. Everything else is a supporting form to the 1120S. The tax return rarely pays tax, so that may be a first that you've heard of this. The 1120S almost never owes any tax. All the income flows to the owner's personal returns, and that is where they pay tax. So that's what makes this kind of so easy, is the 1120S of itself doesn't generate any tax. You're not going to have to create a bunch of documents and discussion with clients about how much they owe, giving them coupons. Now, I will say in certain states there is tax due, so I'm not going to say that there's never an issue, but if you live in a state like Kansas, you will not really see a lot of tax. If you live in a state like Florida, you're not going to see a lot of tax. If you live in a state like Minnesota, not a lot of tax. So most states, you don't have to worry about this. So the 1120S, 5 pages. Then there is the K1. Think of the K1 as the owner's portion of the 1120S. That's really what it is. It's kind of separating out each owner's distributive or allocable share of the income and other items on the 1120S. The K1's job is to show how much of the total return everyone has to claim on their personal returns. Then there's the 8879S. This is the signature page, so that we can show that the client signed it before we e-file the return. Now, I would say that 70% of all returns under $250,000 are just those forms. They do not include the 4562 or the 4797. So these next forms, which we're going to dive into, only affect about 30% of all returns. And we know this because the IRS discloses what percentage of 1120S's have these on it, and I'm telling you it's about 30%. And that's of all returns, not just the under $250,000 group. So it would probably be less than that group. The 4562 is the depreciation form. Sounds scary, but it is really very simple. And when I show it to you, you're going to see that it is not nearly as intimidating as it probably looks. We'll be going over that in a lot of detail. Then even more rare is the 4797. This is when you sell an asset to show the gain or loss of that asset. We'll be going over this one too. And that's it really. There are hundreds of other forms, okay? There's lots of other forms, but you will hardly ever see them. And getting our feet wet with the 1120S, think of it kind of like I'm going to show you what 80 to 95% of all 1120Ss look like. And all those other forms that you've heard about, those pertain to maybe the other 5%, which more than likely are not going to be the kind that you have running through your firm. If they do, we will handle them. We will recognize them, and we will know if they need a fuel credit or if they have some other kind of credit or deduction that needs a different kind of form. We're going to prepare it, but most of the time it's just this stuff. And that's it. So let's get started with the super important one. I'm going to jump into the 1120S first. Okay, so I have created a sample 1120S with several figures for our use and review today. I placed a copy of it in the download section of this lesson in case you want to print it out and get it in front of you. So you can go over to downloads if you want to, pause the video or something, or remember where it's at. Go print it off if you want it in front of you. I don't think you need it, but it's there. We're going to go through the pages kind of in order. And most of that is because I feel like the tax return flows in order. And I'm going to start with page 1. So we're gonna kind of start at the top. Sections A through I. So here's section A, B, C, D, E, F. We've got the names and stuff, and then G through I, okay? So first let me talk about the address. This is going to be the legal address, the place that the business receives mail, okay? So if the business actually operates out of someone's house and they don't have another address, this will be their home address, plus the name of the corporation up on the top. If they operate out of their home, but they also have a mailing address somewhere else, they can put that mailing address on here. Bottom line is it needs to be where the IRS can send confirmations or notices or anything else that they need to, because they're going to start using this address as soon as this tax return has been filed in this way. Over here on the left is section A, and this is the S corporation election effective date. Now, most of the time, this effective date is going to be the same as the date incorporated over here in E. I've shown you an example here where it's not, because you could say that this particular company was an LLC or a corporation and incorporated in 2012 but didn't become an S until 2016. Either way, make sure that you know what the effective date of the S election is. If you did it, you will know what the effective date is, because that's part of what we put on the S corporation election, the 2553. If you're not sure, you can look at last year's tax return and use the date that they show there. The employer identification numbers over here in D. We talked about the date incorporated. Over here on B, this is the business activity code. And if you're not sure about what that code is, don't worry about it. We give you all kinds of options in Halon, so all you have to do is kind of select from the drop down. And then the total assets, you don't have to put anything in here. Halon automatically calculates this for you if it's required and fills this in for you. So something that is kind of important is the corporation electing to be an S corporation beginning with this year? See this item G, yes or no? If it's yes, they want you to attach the 2553. So this is kind of an out. If you're not sure whether the corporation is an S corporation or not, you can attach the 2553 with the tax return and send it along, and more than likely they will allow you to be a S-Corp for this year. So as long as you're filing it with the return, it's good. There's also some check boxes for final return, name change, address change, if anything like that is changing on a tax return, you can check those boxes. And then the number of shareholders is 2 in this case. You don't have to worry about that. Halon will fill all that in for you. So that's sections A through I. Next up, we have the income statement here. And let me point out first, before we get to the income statement, that there's this little caution here. Include only trade or business income and expenses on lines 1A through 21. See instructions for more information. They mean that you should not include passive income like rental income, interest, dividends, royalties, etc. That's because they go on a different page of the return, which I'm going to show you here in a bit. When you're doing your bookkeeping, however, you can put them all where you want. So just put them on the income statement. You don't have to worry about putting them in a special place. What you do need to make sure you do is use a very easy to understand naming convention. So if the company earned interest from the bank on deposits they had, name the account interest income, right? If they earn dividends, name it dividend income. Don't name it ATC income one. You know, Halon doesn't know what that is. When it reads that, it will think it's an other income item and it'll put it in the wrong place. So just use typical naming conventions, and Halon reads all of this and will put it in the right buckets for you. Of course, we have people reviewing all of this, but I don't know if a reviewer would catch ATC income one. You know what I mean? So make sure the naming conventions are very good. And in accounting too, when I show you the chart of accounts, we've got those naming conventions all in there if you want to use that chart of accounts. Okay, on to the income statement here. So as you can see, lines 1 through 21 look just like a normal profit and loss. Has income at the top, expenses or deductions down below, and that sums up to ordinary business income. Notice that certain expenses are named, like repairs. See how they've got rents, they've got repairs in here, they've got taxes and licenses. Anything not named in this section here, any expense not named, is going to go into line 19 called other deductions, and it's just one big total. There's a summary at the end of the return that shows what all of those are, and this is kind of a interesting thing about doing, you know, corporate tax returns, is they really kind of pick and choose what accounts are the most important, and then everything else is lumped into this other deductions line item right here where you see that 5,040. Everything else just gets lumped in here. And I want to make a point about why that's interesting, is because the IRS does not really care what categories each of these things goes into. That may be a bold statement, other accountants may disagree with me, but we never, if the IRS is reviewing something, we never fear that they're going to say, you know what, Chris, we really think that that should be on line 11 rents rather than in other deductions. Because it's all deductible. That's what's important, is that the financials were done correctly and show only deductible items. And you see how the financial accountant is really important to this process, because they're the ones making the decision as to whether something should be on the business financials or not because it's deductible, not the tax accountant who's trying to figure out which line item to put each of these things on, because the IRS doesn't really care. They lump most everything into this other deductions category. So don't worry too much about what you have things named, except for whenever we get over to the Schedule K, I'm going to emphasize this, making sure that some of these other items that aren't on this form get named right, and that's things like interest, dividends, capital gains, rent incomes, charitable contributions. We're going to go through all of it. So it's kind of interesting how they choose winners and losers, and there's a couple of points I want to make. If you know, try to name your account something that's either exactly what is on the form or nowhere close to it. For instance, let's say your client wants to track internet advertising and print advertising, but they want to do it separately on the profit and loss, which isn't a crazy idea, right? You want to kind of track what you're spending on internet advertising, what you're spending on print advertising. Traditionally, both of those amounts need to be added together and put on the advertising line of the return. So make sure each account has the word advertising in it. Don't name it something unrelated, you know, or our AI engine, and this is kind of like what I talked about before with the passive and the Schedule K items, it's not going to recognize it. It's not going to lump everything together into advertising like what we want. So again, try and make sure that the naming convention is right. Another example is fuel. You will not find fuel on this form. So you could name it anything you like. However, keep the word fuel or gas in the account name, because in some businesses, fuel qualifies for a credit. Don't worry about that kind of thing, what gets a credit and what doesn't. We're going to take care of that. Instead, just don't get fancy with your naming conventions, right? Name it what it is, and try and keep any names having the word or words that describe what the expense is in it somewhere. If you don't worry about naming conventions and you just kind of put everything where it where you think it needs to be and name it in a way that is different than that, we're going to lump everything into other deductions, right? So we're going to put everything into line 19 that isn't immediately recognized here. And that's probably not a big deal. I'm just saying, know that if you've got 17 different accounts of advertising here, and you only name 10 of them with the word advertising, the rest don't have it, only the 10 are going to end up here in the advertising column, okay? I've kind of beat that to death. So that's really all I wanted to do here. Now, notice that there are other items here. There's like net gain on here. We're going to get into some of that. But really what the profit and loss for this client showed was $199,000 of income. And then it had these expenses. And then it shows ordinary business income of $178,111. And that line 21 is important, as this is what goes over to the Schedule K and the K1s. That's our ordinary income. And if it's positive, it means that they have taxable income. And if it's negative, it means they have a loss. Then below this section, let me scroll down here. Below, see this guy right here? This line 22A through 27. This is the tax and payment section. And I'm not going to get into this. Just know that almost all S corporations do not have anything that goes in here and is left blank. If you do have an S-Corp with excess passive income or LIFO recapture or something like that, Halon does not support that, will not calculate that for you. So we would upgrade you to Halon Assisted so that we could have the tax return done the way that it needs to be done. But just as kind of a side note, out of the thousands of tax returns I have done, I think I have one or two that have ever had this. And it usually comes from when S-Corp that has been operating for a while converts to S, and there's trapped gains inside the C corporation, which is not worth getting into too much in this discussion, but just know it's a really odd situation to have. So this all is left blank. And then down below here, this is where the officer signs. And then down below here is where the paid preparer information is. And I've taken out the firm and the PTIN, but and this one says Reagan Financial on it, my firm, but just know that this will actually be the Halon firm, and the preparer that is doing the review of the tax return is going to sign here. In most cases, it's going to be me because I've kind of got oversight over the whole system. And then your officer can sign here if you were mailing it in. If you're not mailing it in, the system just types in their name, and we use the 8879 as their signature form. So that is page 1. Makes sense? I mean, page 1's really just the income statement. It's just like you have it in your financial statements, and we fill it in with the right categories. Everything else goes to other deductions, and we move on. All right, so page 2 is kind of like the forms you fill out at the doctor's office. Wants to know all about you, your allergies, and your history. Halon asks you some of these questions during the interview and then makes assumptions about some of the others. The first question is what accounting method you're using. And by default, I usually set up clients as cash, on the cash method. But you can make it the accrual method if you want. Halon will handle that. Remember, most small businesses like the cash method, so they don't have to pay tax on income that they've billed but not received. So if they're billing a lot of things but they haven't been paid, in the accrual method, they actually pay tax on that. But they also get a deduction for the things that they have received a bill for but not paid. So it really comes down to what's your client want to do. I tend to not get too caught up in this, and I usually say, okay, we're going to elect the cash method. And then if you see number 2 here, the second question, and this is asking for the business activity and the product or service. Here, again, don't get too caught up in trying to make this perfect. Just kind of give what the business activity is. In this case, I said ranching, and then what's the product or service? Cattle. If you ever have questions about that, you can email us at support and we'll help you try and sound it out, but this does not have to be complicated. Personally, I'm not even sure that the IRS even looks at this. I think that they put this in here just so they have an idea of what you do in case they ever pick it up for examination and want to see if the expenses are kind of in the same realm of what that kind of business would be. But I don't think it's something that they actually load in their system as something that is tracked. Then there are several other questions here, and I don't want to go through each and every one of them. The writing's small, hard to probably see here. I'll zoom in a little bit, but there are a couple that are important, and it has to do with if this company is owned by other companies and if this company owns other companies. And there's questions about this in Halon, so just answer it correctly. And where you see this a lot is in the parent-child setups that I counsel and recommend, where if you've got two owners that own S corporations, and then their S corporations own a parent company that is the actual operating entity, we're going to have to fill some of this stuff out so that we disclose that they own another company. Don't worry too much about how to do that. Just whenever you're going through Halon, it's going to ask you, hey, is this S corporation, does it own more than 20% of the total outstanding shares of a domestic corporation? You're going to say yes, and then when you say yes, it's going to ask you for the information for it. Down below, there's some other questions here, and you can read through them. They're all pretty easy. Did you have any outstanding shares of restricted stock? Probably not. Has the corporation filed or is required to file 8918, the material advisor disclosure statement? Probably not. These are all very, very rare kinds of situations. One of them that isn't as rare is number 13 down here. Did the corporation make any payments in 2017 that require it to file Forms 1099? If yes, did the corporation file or will it file required forms? This is one that I almost always answer yes and yes. And I have never seen, if the company did not actually file 1099s, I've never seen the IRS ask any questions about it. Where I think they would take a look at it is if you answered, yes, I should have filed 1099s, but no, I didn't do them. I think maybe you might get a notice like that. So answering yes and yes is probably the best solution there. So this is page 2. It just asks a bunch of yes/no questions. Halon makes some assumptions on some of these. Like in question 5 and question 6, we're assuming that the answer is no. So we're going to automatically just kind of answer no on some of them. The others that we're not going to answer no on or just assume anything, we ask them in the software of you. And like I said, if you ever have questions or you're not sure what to answer, just contact support and we'll walk you through it. We'll ask you a couple questions about it and kind of walk you through how to finalize that up. All right, so moving on to page 3, okay? And this is an important section and probably the part that is the most confusing about an S-Corp or partnership return. It's confusing because it's a little bit weird. And because we report most amounts on that first page of the 1120S, unfortunately, certain categories go here. And it's kind of weird. You have to think of the Schedule K, which the reason we call it Schedule K is because it's named as Schedule K right here. And it's this whole page, and then it's a little bit into the next page, page 4. The reason we have to, have these different categories of income is because they really are personal in nature. These are things like interest, dividends, capital gains. While the business earned them, and they were earned in business accounts, they pay different tax rates than regular corporation income. Like dividends, depending on how much personal income you have and how long you've owned the stock, dividends are taxed in different ways. So IRS says, let's break all of that out. The good news is very few of your business returns also have stocks and bonds they trade or dividends that they receive. So this section doesn't see a ton of activity. Let me go through lines 1 through 10, and then we'll kind of keep reviewing this concept, okay? So lines 1 through 10 are kind of what I'd call the core Schedule K lines. And the first line, line 1, is ordinary business income. This is directly from page 1 here. It's direct, that 178,111 is this line here. See this? And that's because later the K1 is going to emulate what the Schedule K has, just broken out by shares of stock. So the first line item here is just a repeat of what was at the end of page 1. Then you've got net rental, which if you have any rental activity, we have to create a form 8825 to show the income and loss from the rental. And then whatever the net income is of that, we put it right here on line 2. And if there's any special income or losses, we put them in here. You're not going to have a lot of that unless you have a ton of rental S corporations, which I typically wouldn't say to do. I would usually put those in a partnership or some kind of LLC structure that's not an S-Corp. Then we have interest income, and here in this example, I put some interest income in here, like, they made interest from the bank. And then dividends. Let's say they own stock, they would put their ordinary dividends and their qualified dividends in here. Royalties, short-term capital gain, long-term capital gain, collectibles gain, if you're selling artwork, Section 1250 gain, and I'll talk about some of this in the gains and loss section that we go through. And then other income. Something that's very important here is this 1231. I did put some 1231 in here so that we can see that when we do the 4797. 1231 gain is from when you depreciate an asset and then you sell it. Part of the gain goes on the first page of the 1120S, and part of the gain goes here. The part of the gain that goes here is the part that you sold it for above and beyond what you bought it for. So it's true capital gain. Whereas depreciation recapture, which I'm going to show you later on in this video, actually goes on page 1 and goes over here, this 39,595. So I've got an example I'm going to show you where I show you both, and we'll get into that more whenever we get to the gain part. But it goes right here. So this first part is important, but you're not going to see it a whole ton. Let me bring up a slide that illustrates a little bit more about how this works. I'm going to spend some time on the Schedule K because I want to drill this. This is the hardest part of the whole tax return. So if you can get this, you pretty much are going to get everything else. So hold on just a second. Let me pull up a slide. So let's take a look at how this happens. So let's say that that we're working on a client that has the following income statement. The income statement I've got kind of there on the left side of the screen. Now immediately, because we are Halon tax advisors, we know that the return is going to show this in two different ways. That the interest and the dividends that we see in the financial statement are going to have to be broken out onto the Schedule K, and the rest is going to go on page 1 of the tax return. Okay, so here's kind of how that works. The Schedule K gets the interest and the dividends, right here. This part of the income statement gets peeled out and put here. And then everything else gets peeled out and put over here. And where this can get a little bit confusing is, see how the net income was 17,250 when we saw all of it? But then because we put the Schedule K here, page 1 of the 1120S only shows 16,500. It's because we pulled $750 out of the income section. So don't let that confuse you when you're looking at 1120S tax returns. It just means that part of the income's here, and then part of the income's over here, and it's all still going to flow to the owner. It's just that it's going to flow to them in a couple of different. It just means it's going to flow to them on a couple of different buckets. Let's take a look at some of the other parts of the Schedule K now. I'm going to take you through kind of the rest of the form. I hope this is making a little bit more sense. We're going to stay on the Schedule K for a little bit. So we covered lines 1 through 10. Let's hit lines 11 through 16. 11 through 16. 11 starts here, right here, and then 16 goes all the way to the end of this page. Okay, so let me just kind of hit some of these guys. So line 11 is not going to be used much going forward with the new 100% bonus depreciation rules, but I should cover it. The Section 179 deduction allows you to fully expense fixed assets purchased in the current year. The catch is you have to have enough profit to handle the deduction. Otherwise, you can't take it. So Section 179 is now, with the new law, not as good as bonus depreciation because you can't create a loss with Section 179 expenses. If you do have Section 179, if you do need it, it's going to go in here. But like I said, you're not going to see it for like the next 5 or 6 years because bonus depreciation, and I'm going to show you depreciation here in a second, bonus depreciation is going to probably take over for it. I don't see why anyone would use Section 179 unless they had some very long-term assets that they were trying to put in place, which usually in these small guys they don't do too much of. So the next line is some you're going to use. You're going to use this next line a bit. It's 12A, and it's charitable contributions. Halon will handle all of this for you. Just know that charity is the same if they do it through the business as it would be if they did it personally. I would encourage you to recommend to your clients that they do not run charity through their businesses because it's just an extra hassle. They don't get anything extra for it. It didn't somehow become an expense to their business, which is better than had they done it personally and it was an expense on their Schedule A. Even if they don't itemize deductions, whenever this charity runs to their personal, they'll still lose it. So there's absolutely no reason to run it through the business. It just creates complexity. If they have to, make sure that you name it charity. Halon will put the charity here on 12A where it needs to go, and then it'll flow to the K1s the way that it needs to as well. I have a whole lesson on charity, and I have a whole another lesson on the Schedule K too. So I'm going to move on for now, and just know that we're going to come back to this some because I've got an entire lesson in this module dedicated to that. You've probably seen it when you reviewed the syllabus for Accounting 1. So lines 13 and 14, okay, never used them in my life. In my life, I've never used them. So I don't expect you will either. Halon cannot handle them. They're a myriad of business credits and foreign transactions. If you have a client that may need these, contact us at support and we will research it and probably put that return into Halon Assisted in some way. But these are very, very specialized credits, and then foreign transactions hardly ever seen. Like I said, I've never used them in my life, so that's how rare they are. And now we finally get to the bottom. We're going to get down into kind of lines 15 and 16 here. Line 15 is used a bit. It has to do with AMT, which stands for Alternative Minimum Tax. And it has to do with AMT depreciation and then AMT gain loss. Know this about AMT. You could go to 99.9% of the accountants that do tax returns and ask them how this is calculated, and they'd look at you and say, I have no idea. I promise you that. No one really memorizes how AMT depreciation and gain loss is created. Most of the time, it is the difference between maker's depreciation and straight line depreciation. I think there are even some caveats to that. I'm certainly not an expert at how to calculate AMT either, but I will tell you that Halon is and knows how to calculate all of this for you, so that when we do the regular depreciation, we're automatically calculating the AMT depreciation and the AMT adjustments. These adjustments are not adjustments to the actual return or what the taxpayer owes in ordinary tax. They're adjustments to their AMT tax calculation, which all is done on their personal tax return. So these adjustments flow to their 6251 on their personal tax return and is all calculated there. Line, I would say, before I get on to line 16, I would say this: if you've got oil and gas clients, they're going to maybe use some of these other pieces in line 15 too. If you do, we're going to upgrade them to Halon Assisted because Halon does not handle anything in the C through F category. So if you've got oil and gas, we're going to move it to Halon Assisted to where we have a little bit more CPA oversight on it and get it done the right way. And then line 16, it's got two important areas. One is the non-deductible expenses and one is the distributions. I'm not showing the distributions on line 16 here in this D in this example, but know that most returns will have something in non-deductible expenses. In this case, this is the 50% of meals that is not deductible. So they must have spent $1,220 on meals. Half of that goes here. And then the distributions, whatever they distributed to themselves as profits, that goes on this line. Again, these are not really tax issues where it changes the outcome of their returns in some way. It is more or less a way to track things that have to do with the shareholder basis, which we are tracking in Halon for you. So it's just a way to report to the IRS some basis changes as it relates to non-deductibles and distributions. So that is the Schedule K. Let me show you one thing. The Schedule K kind of leaks over into the next page 4. See this here, this top part. Investment income, remember we had $200 worth of interest. So it's just repeating it here. It's just repeating it because they want to break out some of this. On the individual return, what happens is if you've got investment expenses or other, items related to portfolio income, it matters as far as the deductibility on the personal return of investment expenses and some other things. So Halon's going to do all this for you, but we should know what this is. It is simply repeating what was all the way up here, right here. Okay, this is not considered investment income, but if there was dividends here, it would total those up and put it right here on this line. And then to end out the Schedule K, we have the income loss reconciliation. And what this is doing, this is kind of interesting. It's taking all of the ordinary income plus everything that was in Schedule K and adding it up and showing you a reconciliation of what the total income from the business is. And that's interesting because this is probably going to be very close, if not exactly, what you show on your books. So that is what it's doing. And you can see right here, all it says is combine the amounts on lines 1 through 10 in the far right column. From the results, subtract the sum of the amounts on 11, 12, and 14, and that's what you get. That's how you get it. Right? Sometimes just reading the form makes you realize that it's just summing up other parts of the form, right? And it's not that complicated. I will say, whew, we're done with Schedule K now. It has lots in it. You could, like I said before, you could ask 99 out of 100 accountants what all that is, and many of them would not know what most of those sections are. The reason is, besides the lines that I spend a lot of time on, most of them are left blank year after year, for client after client. Don't feel like you have to, but if you want to dig into each of them, search Google. Just search Google for the 1120S instructions, and the instructions are easy to read. And you can jump in there and see what every single one of those line items means and what goes into them. And you'll be surprised at how simple some of the stuff is, and then surprised at how complicated some of those foreign transaction amounts and that kind of stuff is. So Halon's going to take care of all this for you, but getting to know the form is an important thing, and that's the purpose of this lesson. Believe me, if you do get into the 1120S instructions, it's a super exciting read. So jump in there. I am going to move on to the next page. And we are almost done. We're almost done with the 1120S at least, because we're on page 4 and it's only 5 pages long. Because businesses that make less than $250,000 are special, they do not, I'm on page 4 here, and I'm going to zoom out a little bit so you can kind of see what page 4 looks like. The rest of page 4 is blank, and we get into page 5 here. But something to point out, if you're a business that makes less than $250,000 of revenue, and $250,000 of assets, less than $250,000 worth of assets, you do not have to complete Schedule L, which is the balance sheet, nor do you have to complete M1 or M2. And when we are doing tax returns at Halon that are less than $250,000, all of this will be blank. So just know that this is not required. Now for the stuff that's over $250,000, it is. So I'm going to dive into it here just real quick. I'm going to start with the balance sheet. You all are familiar with the balance sheet. This is the balance sheet per books. So it is literally the balance sheet from your bookkeeping. We put it in here. It's got different categories. We fill it in, and it's like copy and paste, right? So that's the balance sheet. IRS likes to see it for the bigger companies. And then we get into the Schedule M1 and M2. The M1 is reconciling the book income to the tax income. The only adjustment we have for this return is meals, the 50% that is disallowed. So you can see here that the net income per book was this because it counted both halves of the meals expense. But then for taxes, we add back 50% of that to get what the income is for tax. So you're going to have some adjustments. There's other adjustments possible, but you're not going to see a lot of activity on this because for most businesses, it's meals, sometimes a depreciation adjustment. If they're accrual based, you may see some things on there that make it a little more complicated. But for cash basis, you don't see a lot of that. The other schedule here is the M2. I'm not going to get too much into the M2 other than to say It is a function of tracking what we call AAA, the Accumulated Adjustments Account. And it is essentially a way for us to calculate what can be distributed to the owners without having some kind of taxable event. Because remember, they're already paying tax on the income. So in most cases, this adjustment, this AAA account, this balance at year end is going to somehow match up to like retained earnings. In 99% of tax returns, that's what it matches, because whatever the business owns minus its liabilities is able to be distributed back to the owners if they want to close shop and move on. Sometimes owners will go and get a loan in the company's name that they are not personally guaranteeing, which means if they were to then distribute all those loan proceeds to themselves, that may be a taxable event because they did not have basis in their company because they were not personally liable for it. But unless you've got people doing that, most of the time banks won't lend a company without making the owners personally guarantee unless you've got a really, really big corporation. And if you do, more than likely Halon's not doing that tax return for you. So I'm not going to get too much into this. It is important to know as we're finishing up the 1120S, the less complicated you kind of imagine this process to be, the more confidence you're going to have in recommending it. And I hope going through the form here has kind of showed you there's really not much to this. I'm going to summarize, kind of, especially for those clients that are under 250,000, which are our core Halon targets. What they get is they get this top part filled out. They have their income statement flow through here. On page 2, they have some questions answered. Page 3, their Schedule K will almost just be this, maybe some charity. Most of the time they do not have gains. Most of the time they do not have portfolio income. So it may only be this ordinary income piece. If they don't run charity, this whole thing may be blank until you get down here into depreciation adjustments or some of these. Then the Schedule L is blank and the M1 and M2 is blank. So you see what I'm saying? With this size client, this is not a scary thing. We're just going to fill it out, give them all the wonderful benefits of not having to pay so much self-employment tax and kind of move on. Let's move from the 1120S now, and we're going to go into the K1, the K1 form, which is right behind the 1120S. You can see here was page 5 of the 1120S, and now we're going to hit the K1 here. Yeah, so here's the K1. The K1 is related to, guess what? The Schedule K, that's right. It takes the schedule and breaks down each, number by ownership. In this example, I've got 2 owners. I've got Han Solo and Luke Skywalker. They each own 50%, so they each get 50% of the Schedule K. We can see some of that on the left where the company info is. So you see here where it's got the business name and the EIN, and then it's got Han's name and his social security number, and then it shows that he owns 50%. And let's just kind of take a look at what this is doing. Let me zoom in on this real quick. See how this says line 1, ordinary business income, and it's $89,056. What's that from? Let's go back to the Schedule K. Line 1, $178,111. So what we're doing is we're taking line 1 and we're dividing it by 2 because they each own 50%. When we come back here, that's Han's share of the ordinary income. There was $200 of interest income, remember? Han gets 100, and then if we look at Luke Skywalker now, he gets 100. He gets half of this. 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 If you had 10 shareholders that all owned 10%, then they would each get a 1/10 of whatever was on the Schedule K. That's it. That's all a K1 is. I want to make a point. I'm not going to go into the K1 in huge depth because, like I said, it's an exact replica of the Schedule K, just broken out by whatever their ownership percentage is. I want to make this point, though, here about a K1. A K1, if you think about it, is kind of like a W-2. And now hear me out. A W-2 has the business info on it, has your info on it, right? And then has wages and withholding. A K1 has business info on it, your info on it, and then your income on it. broken out into boxes, just like a W-2 is broken out into boxes. And here's the important part. Here's what I'm trying to say to you. When you're explaining to clients about doing their own personal return after you've done their business, trying to sell them on the idea that they can still use TurboTax or still use another kind of software, even walking into a tax preparer, you're going to tell them that getting the K-1 is no different than you issuing them a W-2. It's the same stuff. All they got to do is take the numbers on this thing and plug it in to their personal tax return, and away they go. This is not complicated. The tax industry wants everyone to believe it is. And there are certain things about taxes that are, but the K-1 is not one of them. It is not one of the complicated things. It is simple. And we need to relieve the client of believing that this part of it is hard. What you do is hard. The books are hard. The corporate tax return, the payroll, the officer's compensation, all of that is hard. But getting a K-1 and plugging it into your personal tax return, that is just as easy as plugging a W-2 into your personal tax return. And I'm going to show you something. Let me show you the screens in TurboTax here real quick. I just want to kind of show you what they look like. All right, so this is an actual screenshot that I grabbed of TurboTax. And when you say, I have a K-1 that I need to enter into my tax return, it says, okay, enter the income or loss from box 1. And so you remember box 1, we plug this in, right? And we click continue. When we click continue, it then says, okay, show us the other boxes that have something in it that we need to do. So boxes 4 through 9 have something. So I kind of check the boxes that have something in it. And then for each of those boxes, it just asks you some more questions about, fill in the interest income, click continue. And you do that and you're done, just like the W-2. My point being, this is not hard. Make sure your clients understand that this isn't hard. And you will see that what we're doing, that's the hard part. When we hand them off the K-1 and they can do their own personal tax return, that is not nearly as difficult. So that's the K-1, right? These pages are right behind the 1120S, and there's one for each owner. One thing to note, Halon does not distribute the K-1s for you to these owners. So you will need to provide your client a copy of their tax return. You give them a copy of their tax return. Halon makes that available to them. They have to review it, right? They can print that if they want to. But if they ask you for it, send them the K-1s from Halon and let them plug that into their personal tax return, each of their owners. Now, you don't have to be responsible for sending it to each of their shareholders. That's the company's job. So the company gets the tax return, and then they send the K-1s out to everybody. Most of the time, you're going to be dealing with 1 or 2 owners here. So this isn't a big deal. Let's move on to the 4562 for depreciation. All right, here we go. This is the 4562. And, here is another fairly ominous looking form, right? I mean, there's lots of text. There's lots of blanks. It's like, holy, what goes into all of these things? Holy buckets, right? If I thought I had to fill all of this out, I would be worried. But I'm here to tell you, I never do. There are really two lines that you'll be dealing with, and I show them right here. The first one is for the assets placed in service prior to 2017. So I'm going to start with the second number here. See line 17 here where it says makers deductions for assets placed into service. So what's happened is you've entered the fixed assets for the business into Halon. What happens is Halon reads the fixed assets in your QBO file, pulls them into the software, and then says, tell us what these are. And you say, this is a desk, this is a chair, this was a computer, this is a car. And it says, okay, that's all we needed, goodbye. Then Halon calculates all the depreciation, adds up everything that was placed in service before the current year, and says, okay, here's the depreciation for all those assets that were purchased before. And it's all just added up right here, 11,841. That's it. That's all that happens for all of those assets. Then, for the assets placed into service this year, all of them are going to be fully depreciated in 2018, right? I'm showing the 2017 form, but in 2018, when you're preparing returns and going forward from now, 100% of everything that is purchased that is under 20-year useful life, which is almost everything that small businesses buy except for real estate and some leasehold improvement stuff, is going to be fully expensed. And that goes on line 14, called special depreciation allowance. This is where we put bonus depreciation. And we just take everything that they bought and we put it right here because it's being 100% expensed. Then what happens is down at the bottom, this is just one page form, 4562. We take the 29 and we take the 11841, we add it up. Okay? This, when we add it all up, boom, right here at the bottom, that's our total depreciation for the year. And then this goes over to the first page of the 1120S. Remember on the first page we had a line item called depreciation? That's where this goes. And it just adds into the ordinary business income, subtracts from it really, right? It's a deduction. That's it. Not scary. This form is really not a big deal. Now in prior years, before we had this 100% expensing, when we bought things in the current year, we'd show the 3-year property here, and we'd show the 7-year property here, and all of this. But that's all going to go away for these kind of clients now in 2018. Now, let's say you had a client that really did go out and buy a $200,000 piece of property that was real estate, and we needed to depreciate it that way. That's fine. Halon's got that category, and you're just going to say, okay, what was this? In the drop down, you're going to pull down and say that was a rental property or as a commercial property. Then Halon does all the depreciation calculation for you, puts everything on the 4562 where it needs to go, and you're moving on again. So this is not an ominous form. Just looks it, right? That's the 4562. When Halon takes care of it for you, you'll see really, really easy. Now, the next form I want to show you is the 4797, and this one will throw you a little bit of a curveball, but it's a good curveball because you're learning something new. So let me pull that one up. So here's the 4797, and I will say this. This form and the Schedule K probably tie for being a little bit the trickiest. I don't think the Schedule K is that tricky once you understand that certain categories of income and deduction have to go on that form rather than page 1, right? But this one's a little bit tricky because you're selling assets and they have to be broken down into 2 different things, and there's just a little more going on here. But before you worry, let me ask you this. Let me just ask you this. Think about this. How many of you deal with clients that sell a desk after they've used it for more than they purchased it for? What about clients that sell a tractor for more than they purchased it for? Not many, if at all, right? That is how often you will see this form. That's because most small business owners rarely sell assets that they use for the business. They usually pitch them, they wear them out because they're worthless. And probably automobiles is where this form comes in some, but as you will see in the auto expense video, which is part of this module, usually those are part of an accountable plan, so not a business asset, and thus not doing this. So this is very rare. This is not something you're going to be doing a lot. But let's just say, so we can see how this works. We had a desk that we purchased for $70,000, $70,200, expensive desk, gold-plated desk, and sold later after we had depreciated some of it, so we'd owned it for a few years. We ended up selling it for $85,000, like it's some collector's item or something, right? Crazy, I know, but it's going to illustrate a point. Now, before I continue, I do have to tell you, I have an entire module, an entire lesson, about asset sales in accounting too. So I'm not going to go into every single little detail of this because that lesson goes into every single detail of asset sales and this form and a lot of other stuff. I'm just going to go into enough to kind of show off this form a little bit. So first, I'm going to go to page 2 of it. Let me just show you something here. I'm going to scale out. There's 2 pages to the 4797. There's this page, and then there is the second page here. And I'm going to start with the second page because it illustrates the sale. And let me go through each figure here. So let me zoom in a little bit. we've got this desk. We called it Desk 3. And we bought it January 1st of 2012. And then we sold it October 1st of 2017. Now, what we have here, this is property A. If we had another piece of property we're selling, we put it in B, C, D. Property A sold for $85,000. See that gross sales price right there? And the cost was $70,200. Now, normally your gain, if you didn't depreciate it at all, your gain would have just been $14,800. But since we depreciated it, meaning took an expense against it for several years, we have to enter the depreciation that we took over the course of its lifetime with us, and that depreciation total was $39,595, which means it has an adjusted basis to us of $30,605. So what the tax form here is telling us, since we took depreciation on it, we're going to act like the cost basis, what we bought it for, was $30,605. So when we sold it for $85,000, we have a gain of $54,395 because we got to expense that $39,000 in other years. It went against our income to reduce our income for us. So we're going to have to do something called depreciation recapture. Like we're having to bring it back in and we're going to have to pay tax on it because really the property didn't depreciate at all, did it? So this total gain is $54,395. If it's Section 1245 property, which most tangible property whenever we sell it is, and Halon will calculate all of that for you so long as you told it that it was a desk, the depreciation allowed was $39,595. And so I'm going to scroll all the way down here to this part. Let me zoom in now a little bit more. Remember how I said the total gain was $54,395? Well, we separate that into two pieces. One is the $39,595. Remember, that's the depreciation we took. And then $14,800 is the gain on what we originally bought it for versus what we sold it for. And what's interesting about this is, remember these two numbers, this 35 and this 14. I'm going to go back to page 1 now. I'm just going to scroll up and we see these two numbers here now. Let me shoot back in. Gets too small on us, doesn't it? Okay, so here's what we see. First, we have this $14,800 goes right here. The gain, if any, from just the sale of the asset over what we had originally paid for it. So this is what we're going to call Section 1231 gain. And remember that $14,800? It goes right here on the Schedule K. $14,800. Then if we come back here, this $39,595, that's the depreciation recapture, it goes here as a net gain loss. And what happens really is this depreciation recapture means we just pay ordinary income tax on it. Because look, it's just like the $199,000. We just add it all up and it gets kind of lumped together in this $178,000, right? This other amount, this 1231 gain, this we're going to actually get kind of a capital gain rate on this. We're not going to have to pay the full tax rate on it because this really is capital gain. It's really the price or the gain on an appreciating item, kind of like stock almost. So this 1231 gain gets broken out and sent to the shareholders via the K1. We already saw that, and that is how the 4797 works. I mean, really, all this other stuff is just kind of, it's a way to add up everything in these different categories. But really, the main gist of the 4797 is to say, okay, what part of this needs to be ordinary income, which is depreciation recapture, and what part of this needs to be something else, some kind of capital gain. And so you're taking page 2, breaking it down somehow, depending on what kind of property it is. See, this was 1245 property. If it were 1250 property, we'd do it a little different. If it was 1252 property, 1254 property, I'm going to go through all of that in the gain lesson. So don't worry about that for now, but this form just separates it out. Long-winded Chris, but wanted to make sure I'm being thorough with this. So that's the 4797. Halon does all of this for you, so long as it even says if you sold this asset, how much did you sell it for? If you do the bookkeeping, as I'm going to show you in the gain lesson in accounting 2, if you do the bookkeeping where you account for it in QuickBooks Online, it'll even read that. So there's lots of ways to make sure this is correct. And of course, you've got accountants reviewing all of this, making sure you're in good shape. All right. That's the 4797. We've only got one form left. We've been on here for a while. I know it's a long video, but we've got one form left, and then I'll let you go. So hang on. Now, this is an easy form. So there's some figures at the top, right? And down about midway, we have the client sign. So the client sign's right here. Right here. And there's a couple of different options. Halon is going to create this form for you, and most of the time we're going to enter the PIN for them. It'll be some random number right here, like this 22222. Doesn't matter. You don't need to know it. The client doesn't need to know it. All you've got to do is have the client sign this. We're going to have two options. One is an e-sign, where you can send the client a link that they open and sign this online with their computer. There's also an option to download it, to print it out, and then to upload the signed copy back to Halon. So you got a couple different options to do this. There's some figures up here that relate to what the IRS wants to see in this form, and that's it. That's the 88. That's called the 8879S. We do not file the tax return until this is done, and this does not go to the IRS. This is something you need to just keep in your records. You can keep it in Halon. Halon's going to store it for you. If you want to print it out after it's been signed, you can do that too. But we don't fire this off to the IRS. We just keep it in case the IRS ever says, hey, did so-and-so sign that return? And we say, yeah, here it is. I've never had that happen, but we keep them anyways, right? At least for 3 years. So this is the signature form, and that's all of the forms. I don't have an action plan for this particular video because this was more than a documentary kind of like a documentary, right, type of lesson. But I do hope that you can see this is not some scary thing we're doing. And if you want to dive into it more in detail, jump into those 1120S instructions. They're easy to read, and they are, extremely informative. Thank you for watching. I know it's a long video, but I hope you found it interesting and helpful. And I have lots more for you to see in this module, so I will see you in the next video. My name's Christopher Reagan, and this is the Small Business University.